Good morning, everyone. We'll start in a few moments. We'll just let people arrive. Good morning, everyone. If you've just joined us, this is the Fees and Advertising seminar. We'll start in a few moments once people have gathered. Good morning, everyone. If you've just joined us, we'll be starting in a few moments. Good morning, everyone. We'll start in just a few moments. Tēnā koutou katoa, ngā mihi nui ki a koutou katoa. Nau mai, haere mai. It's my pleasure to welcome you to the fourth of our 5 in-depth seminars on the changes to our credit laws. I'm aware that some of you will have watched yesterday's seminars, and so I'm going to apologise in advance for any repetition of the outline of the session and housekeeping. So bear with me. Many of you will have attended our overview seminar a couple of weeks ago. However, we know simply from the large number of attendees here today and at our other sessions that some of you didn't. So if you missed it and you want to see that high-level summary of the Commission discussing the 5 main areas that are changing, these are responsible lending, due diligence, directors' duties, today's session, fees and advertising, and also certification, as well as hearing from Commission leaders discussing the education and enforcement approach the Commission is taking, then you can find a video recording of that session on our website. There's a link in the chat for you. We also made a series of handouts. These are really informative. They detail the main changes that are underway. If you've not received these, you can email us, or again, they're available on our website, and again, the link's going to pop up in the chat. For those of you that did attend the high-level seminars, I'd like to thank you so much for filling in the survey at the end. Your questions were thoughtful, they were really relevant, and they helped us make sure that these in-depth seminars run in a way that delivers you the information that's most useful to you. We've used your queries to structure today's discussion, and we hope that's what you need. So, as you know, today's seminar focuses on fees and advertising, and our expert James McIver will be addressing some of your key questions and then available for a more informal Q&A chat session at the end. The session is booked to go for 45 minutes, but because of the nature of the content, we suspect it might wind up a little early. And just a note, the final session in this series, which is on certification, starts at 11:30. So before we get started, I'll open in the usual way with karakia. Whakataka te hau ki te uru, whakataka te hau ki te taonga, kia mā kena kena ki uta, kia mā taratara ki tai. E hia ki ana te atakura, he tio, he hoka, he hauhunga, te hei Māori ora. Before inviting James to speak with you all, I want to go over some housekeeping. If you have a technical issue, please raise your virtual hand. It's under the reactions section on the bottom right of your screen. And then Penny will reply to you in the chat function so that you can talk backwards and forwards with her and she'll see if she can help you. I'd like to introduce Penny now. She's handling our Zoom. Welcome, Penny, and thank you so much for helping us out.
Kia ora, Sonia, and kia ora koutou. It's a pleasure. So as Sonia said, I'll be handling the chat function today and putting through any of your questions to James. You can write these in the chat at any time, or you can note them in the survey that will pop up when you exit the webinar. Kia ora.
Thanks, Penny. So today's session covers two things: the rule changes that come into effect from December 1, 2021 that affect advertising, and then also the setting of fees. So we're going to start with a quick recap on the changes, and I'd like to welcome James, who's going to start talking to us about advertising. Kia ora, James.
Morning, Sonia, and morning everyone on what is a long-awaited level 3 eve for me. So advertising. The CCCFA has a number of responsible lending principles, of course, found in section 9C. One of those considers advertising. So as a lender, your advertising or any that you have instigated or authorised must comply with advertising standards found in new regulations, and also cannot be misleading, deceptive and confusing. So the regulations are where the changes can be found, and they're in two parts. The first is a list of do's. So if you include certain information in your advertisements, the regulations require you to add extra information. And then there are the don'ts, which stipulate advertising practices that are prohibited. The regulations can be found in the Credit Contracts and Consumer Finance Amendment Regulations 2020.
That's great, James. And I can see Penny's popped that link in the chat so that people can have that to refer to. A quick note, we are recording this session, and the comments that sit in the chat box, including things like these links, are also available to you afterwards when you're watching the recording. Now, James, you're going to chat about fees as well.
Yes, so fees have always needed to be reasonable, and the CCCFA spells out the different spells out tests for the different types of fees, and there's nothing new there. But from 1 December 2021, section 41A comes into force, meaning that you must keep records about how you've calculated your fees and any reviews that you conduct. These records need to be kept for 7 years, and remember that they can be requested by the Commission. So to help you to comply with these changes, there is some useful additional information in the Responsible Lending Code, our credit fees guidelines, and remember that those are currently in the process of being updated, and also the advertising and fees handout.
Great. Okay, so we will pop some links to, of course, the code, which I'm sure everyone knows, but it's quite good to have it handy. The credit fees guidelines, and as James said, remember that's being updated. And if you need a copy of the advertising and fees handouts and you don't have it, just send us an email. Right, so James, let's get to some of the questions which came through after our survey from the last overview sessions. We had one about the Responsible Lending Code regarding disclaimers and advertising in social media. So the lender asks, the Responsible Lending Code on online advertising says where the regulations require that an advertisement must state particular information, that information should be presented in the advertisement itself. Lenders should not rely on providing the required information on a separate website that the advertisement links or directs the consumer to. And then the question is, does it mean that the disclaimers should also be made in the body of the advertisement? It may not be possible for ads on Facebook, where the lender provides all the key information on the body of the ad, but the disclaimer is normally made available by clicking on a link. Can we still allow this one-click option for advertising like Facebook ads? James, what do you think?
Yeah, look, the short answer is no. But to pad that out a bit, the Responsible Lending Code gives some help in this. It says that where the regulations require that an advertisement must state particular information, that information must be presented in the advertisement itself. You shouldn't rely on providing that required information on a separate website that the advertisement links or directs your customer to. So this also applies to the disclaimers in the prohibited advertising practices section 2. So for example, if your advertisement includes a reference to the speed of approval in minutes or hours, you must also include a prominent reference to your responsible lending criteria for inquiries. So for example, at James for finance, you could be approved in only 1 hour, subject to responsible lending inquiries. So the regulations, I think, crucially will need to be taken into account when you're choosing how to advertise. So if you do not have the ability to include all the information required, you should reconsider that type of advertisement or the messaging that you're putting into it. Also, if you're a high-cost lender that's charging over 50% per annum, there are additional advertising regulations covering your specific advertising. So from 1 December this year, every advertisement for a high-cost loan must include a prominent warning that the type of loan should not be used for long-term or regular borrowing and is only suitable to address temporary short-term cash needs.
That's great. Thanks, James. So there's a question here about radio advertising, which I think is, something that's relevant here. The lender asks, what needs to be included in a radio ad that only advertises who we are and to get in touch for a loan, rather than advertising interest rates, etc.?
Yeah, so in that sort of simple advertising, the regulations generally require you to add additional information if you advertise certain aspects of your loans. For example, if you advertise interest-free loans, you'll need to give the additional information about the fees that will be applicable. If your advertisement does not include that trigger information, as I call it, you won't be required to provide the further information. So in this case, where your radio ad simply says, contact James for finance for great loans, then this doesn't include any of the trigger information, meaning the regulations will not require you to give any further information. I should note, again, with the high cost loans, that if James for Finance was a high cost lender, you would still be required to have the warning I spoke about before, as this is applicable to every high cost loan advertisement.
So that's that responsible lending warning.
Yeah.
Great. So there's another question regarding advertising and advertorials. And so the question says, an advertorial being an article that a magazine writes for you, but it's written in the form of a story, a news story. So the question says, what are the guidelines for advertorial type of advertisement, e.g., an article or story written and provided by the lender to the press?
Yeah. So the key there is the CCCFA definition of advertising, and it's pretty wide. So if the intention of this advertorial is to get the borrower to inquire about your loans and is authorized and instigated by you as the lender, then it will be captured. Simple as that. So with the advertorial, the advertising regulations will apply in this case. This means that if you use, again, any of that trigger language, you'll need to provide the further required information. So for example, if your advertorial mentions the interest rates that you offer, you'll not be able to simply say from 10% per annum. You'll need to specify the range of costs or range of interest rates, I should say, that apply, that is applicable. Outside of the standard, don't also forget about the general responsible lending principle applying to advertising. So your advertising should not be misleading, deceptive, or confusing to borrowers as well.
That's great, James. Thank you. Now, let's move on to fees. So we had some good questions around fees, and there's one about how they're calculated and the records. So would you like to just talk to us a little bit about how fees can be calculated and the keeping of records?
Yeah, sure. The first session was quite short, with only 10 minutes on fees and advertising. So happy to give a bit more explanation around that. So you must keep records about how each fee is calculated for the purposes of Section 41A. That's the important change. And these calculations must demonstrate that the fee is not unreasonable at the time the fee was reviewed or calculated. So, I often get asked if there's a way that this should be done, or if there's a standard way of calculating fees. There's no specific guidance in the Responsible Lending Code on exactly what's required in terms of record keeping. And I think that's so that it can keep it free for you to do it whichever way suits your business. However, it does provide a useful description of what needs to happen to help you. So you should, and I'll just slow down for this part because it's really, really important. You should assess the costs likely to be incurred in relation to the matter giving rise to the fee. So your assessment should take into account past experience in relation to the level of costs incurred for those activities for the same or similar credit products, but apply that experience on a forward-looking basis to assess costs that are likely to be incurred in the future. And that will apply similarly to estimates of fees that will be that you are anticipating and charging as well. So how does that look in practice? Well, I want to take you through a couple of different approaches that you could take, one of which I talked about in my first presentation. So let's look at that methodology again. Firstly, identify each category of cost that is relevant to your fees, and there will likely be a number of those different cost categories. Next, consider the amount of each cost category that is relevant to each fee. So if I use an establishment fee for an example, and I'll use that in most of my examples here, some of those are going to be easy to determine. The credit check cost might be a standard amount that you charge for each approved loan, and other categories will require more consideration. So the cost of your approval staff member will need to be factored. That might be a little bit more complicated. So if I give an example of your approval staff member, you'll need to factor in non-establishment and non-transaction specific costs and remove these. So let's have a look at an example of that. Your staff member may also, in addition to approving loans, carry out general business tasks. So these are not establishment activities, so will be out. Your staff member may also work on a loan that doesn't go ahead for whatever reason. So this is an establishment relevant activity. However, it's not transaction specific, as that activity doesn't relate to the loan that is being charged the establishment fee. Now, taking the total of all those relevant costs together, divide this by the number of fees that you anticipate you expect to charge. And remember, just like with your costs, you'll need to apply a forward-looking approach to estimate how many fees you'll charge. And the result that you'll get is the fee that you'll charge the customer.
That's great, James. And I'll just remind everyone that these slides will be sent out at the end of the session, along with a link to the recording of this session. So you can take notes, but the slides will be available for you.
Now, that's excellent. So another approach that you may want to choose is to cost each activity. Again, using an establishment fee as an example, identify each step taken in establishing that loan. And with that, you'll want to take into account the 4 actions that are described in section 42 of the CCCFA, and allocate a cost to each step and each part that makes up those steps as well. So it may be that, for example, you work out your staff member's hourly rate, which can include their salary and any associated appropriate overhead costs. You then could determine that it takes 1.5 hours on average, for example, to establish a loan. From there, just add other costs that are incurred, say a credit check cost, for example, and then putting all those blocks together, that will make up the fee that you'll charge. So in all cases, really important that this is forward-looking and it's all based on estimates. To ensure that your fee remains reasonable, it'll be important to review your inputs of any fees calculations regularly. And by this, I'm thinking of both the amount of the relevant costs and estimates of fees to be charged. I'd also suggest to you doing a big picture review to ensure that you're not over-recovering your costs. I've seen a lender in the past who, if they simply looked at their financial statements, they would have seen that total fee revenue exceeded the total costs of the business. And that has to be a red flag.
That's fantastic. It's really good to get that detail. And the examples that you're using for me certainly are really helpful. I hope they're helpful for our viewers. Hey, you spoke about the calculation of establishment and credit fees. But what about the calculation of losses? There's been a couple of things come through the chat in relation to this. And I wonder if you could talk about, perhaps an example, especially, maybe thinking about when someone wants to pay off their loan early. How does a lender work those out?
Yeah, sure. So what we're talking about here is when a customer repays part or all of their fixed rate loan early. So section 43 covers that off, and it provides for the rules for calculating early prepayment fees. the idea of these fees being a loss or cost recovery still holds in these calculations as well. So you don't have to charge any fees, of course, but there are two types of fee in relation to this that are permissible when a customer prepays their loan early. So there's a fee to recover any losses incurred when the contract is broken, and also an administration fee. So we'll start with the administration fee. This should be calculated in the same way as other credit fees, in that the fee may recover the closely related transaction-specific costs associated with processing the early prepayment. Secondly, when a loan finishes early, you won't be receiving the full interest income from the loan. In this instance, you can recover any losses associated to that. And those losses are usually made up by the difference in interest rate from the contract that has been broken and a new loan that you can enter into with a new customer. So bear in mind that there must be an actual loss to recover. That's really important. If you've got a situation when your interest rates can change both up and down, and I think home loans are always a good example here, they could be higher when those funds are re-lent, and in that case, there's unlikely to be a loss to recover. So to help you calculate your loss, the CCCFA regulations give you a safe harbor formula, which assumes that you'll re-lend those funds immediately. So you're free to use that, or you can use your own procedure as long as it's appropriate. However, remember that we would expect in any of your own procedures that you would have taken reasonable steps to mitigate that loss in terms of re-lending that money out. And the credit fees guidelines actually have some really useful resource on this and have some quite good detail in there. So I'd recommend having a look at that.
Yeah, those guidelines are so useful. It's interesting. We had a question come through after the last session about kind of someone wanting more details or more guidelines. So I think it's useful to ask that question now. And so the lender asks, has the Commerce Commission considered preparing an example spreadsheet which smaller firms could use for the calculation of fees, which would make it easier to comply using a protocol which is acceptable to the Commerce Commission, or at least provide a guide? It's an interesting question.
Yeah, look, Sonia, we consider that the guidance in the Responsible Lending Code and our credit fees guidelines give enough to develop an approach. So the Commission isn't going to be developing any kind of example spreadsheet. But I will note with that we've investigated a number of, has had a number of fees investigations in recent years, and it will be a lot of those additional learnings that will feed into the updated credit fees guideline that I talked about. So that should be really helpful, hopefully, to lenders out there. But when you do develop your workings, remember to document as well how you're working out the costs and the estimated number of fees that you'll charge. And this will be important to remind you of what your thinking was when you review your fees, and also if the Commission asks you to explain your workings.
That's great. Hey, James, there's a couple of questions coming through the chat now about fee calculations. And I know we've had both in the previous one, and also I've seen it kind of coming through here about the hedging issue. I wonder if we could talk about that now. So one of the questions that's come through says, how can future vendor or supplier pricing be hedged when setting our fees in a way that's compliant?
Yeah, of course. And that this happens quite often, right? When you're trying to calculate your fees in advance, it's not easy. And look, I really like the wording of the Responsible Lending Code when it says, because fees are set on a forward-looking basis, the guidance is not intended to suggest that there can or be exact precision in terms of matching fees to the likely costs or losses. And I think that that's a really nice surrounding for this kind of a question as well. But I reckon you've got two options with hedging. The first is to build that into the averaging costs that you do. So if we look at premises costs, I should say, for example, if you're in a larger building and you know, for example, from when you're reviewing, in a month's time, you're going to be moving into a smaller premises that's half the rent, you'll be able to look at your projected total rent and take into account that 1 month at the high and then the rest of the time at that lower. And that may be appropriate to do it that way. Alternatively, the other way is to wait till things change, and then you can review your fees at that point. So in that example with the premises cost changing, the rent dropping, it would be at that point that rent drops, you would review your fees at that point in time.
Brilliant. Hey, I'll just let everyone know that Penny has put a link to the guidelines, which are going to be updated, I believe, sometime before the end of this year. And that's popped up into the chat now, so you can follow that link through to the guidelines. James, I wonder if it would be useful to talk about what doesn't meet the standards, you know, and to describe, you know, that almost if we're thinking about the don'ts, you know, what won't meet the standards.
Okay, so talking about the advertising standards there.
Yes, yeah.
Yeah, one thing that comes to mind, which I do see a wee bit, is using that lowest interest rate that you'll offer as a hook to get customer attention. So as an example, you know, call James for finance. We have interest rates from only 10% per annum. So that statement on its own, without the range of interest rates that James for Finance will offer, will no longer be allowed. And similarly, that will apply to instances where you're advertising, you know, $45 per week. Again, if you don't have that total amount of payments, if they can be ascertained, that's not going to be able to be used.
That's great. Hey, we've got one that's just come through on the chat, or it came through a little bit earlier, but I think it's relevant now. And it might mean that you're just sort of expanding a little bit, but I still think it's useful. So one of our viewers asks, what about lenders advertising interest rates on social media? Would you like to expand on that a little bit?
So again, it'll be the same thing. You can advertise interest rates, and it doesn't matter the medium that we're talking about. That definition of advertising is very, very wide. But if you're advertising an interest rate, you need to make sure that you're advertising a range of interest rates available. Similarly, if you're advertising interest-free, zero interest, you'll need to give that information, that required information about the fees that will be applicable. So it doesn't matter if you are using an advertorial, Facebook, any kind of social media, the message is the same, that you'll need to have that. If that trigger information is mentioned, you'll need to have that additional information that's required.
Great. Hey, there's a good question here, I think, that will be useful for people to hear, but it makes me smile because I think people are liking having a Commerce Commission expert in the room. So it's in relation to fees calculations. And they say, what's your top tip for getting this right?
Right. I think from experience of the last little while, getting the estimate of the number of fees that you'll charge right is something that's particularly difficult. So I think that would be the area that I'd really focus on. Yeah, it's easy to make mistakes here, and the compounding of the numbers of fees that you'll estimate, it can be wildly different depending on what's happening out there in the market or with your business compared to a cost, which may be a lot easier for you to manage. So what do you need to consider? Think about your demand and how that's likely to change. So are you spending heavily on advertising? Are you looking to open a new branch? Are you looking to run a promotion with, say, a reduced interest rate? All of those things are going to impact demand. So you'll need to build that into, so for example, with an establishment fee, you'll need to build that into the estimate of the fees that you'll charge. And I think actually now is a really difficult time to be setting fees, if I'm honest, because of the impact of COVID-19. So I see that as a huge challenge for lenders. So not only in demand will that have an impact, but I've also seen it impacting on costs as well. So I think this is where review comes in. So where you've got these changes happening, where things become unpredictable looking forward, then I think it's more important that you review more often. And so when you start deviating away from where you thought it would be, then you'll need to review the fee.
Excellent. That's great. Hey, so there's an interesting question that's come through about the Commission's position on averaging. And I think that could be a useful thing to discuss. So they simply ask, what's the Commission's position on averaging? Is that something you can speak to now?
Yes. Yeah, so look, averaging can be fine if it's done appropriately. So maybe I'll just explain what averaging is so everybody knows what we're talking about. And I'll use my establishment fee as an example again. So if you've got a staff member who's approving loans, it may be that they take an hour on one loan, an hour and a half on another, and an hour and 15 on the next. So we're not expecting you to go down to that granular level of how much time it takes that staff member to work on each loan to therefore work out the fee. In that case, to work as an average, so long as the loans are, the products are similar, it's going to be appropriate to work out an average time to approve those loans across all of them for the sake of working out your establishment fee. That's an instance of averaging done properly. But let's say you've got a situation where you have a threshold. So under $5,000 loan has a particular approval where the staff member can approve that. And then anything above $5,000 requires an additional manager approval. You've got a material difference in the costs that will be incurred in those situations. And in that instance, I would say that it would be more appropriate to charge two different fees, the higher fee for those requiring the higher level of costs, those above 5,001. One part actually I would encourage you to look at is those third-party costs right at the start of the loan. The ones where you're checking the ID verification for AML purposes and credit checks. It may be that you're doing different types of checks for different customers. Say, for example, a customer has different levels of security on the loan, or you're just requiring extra ID checks. And that might be an area where it's not appropriate to average because you're not charging the same costs for different customers. So in those instances, it might be that it's better to separate those out and charge for those individually as that cost is incurred.
Excellent. That's good information to have. Hey, James, there's a few questions coming through which are talking about that social media advertising again. And I think the answers are probably going to be the same, but I'll put it to you and let's just see, because it's something that our viewers are really interested in. So there's one question that kind of echoes what a couple of people have been saying. What if we do not have enough space to show our complete disclaimers on the ads like Google search paid ads?
Yeah, so I think in that instance, it's a case of one, being conscious of the medium. So the message is the same. The regulations require you, if you're advertising, it doesn't matter the medium. If you use that trigger information, you need to have that further information. So one, in association with that, is consider the medium. If you can't fit it, you may want to reconsider. But secondly, and importantly, feeding into that is the messages that you're applying. So remember, if it's call James for finance for great loans and you're leaving it at that, there's no use of that trigger information. There's no information which requires that additional detail. So think about your messaging along with the medium and make sure that you're going to be able to comply with the regulations with both of those parts.
I know you covered it off before, but do you want to clarify for everyone what trigger information is? What's your definition? Can you give us a couple of examples?
Right, so that would be, the trigger information examples would be those listed do's that I talked about. That's, for example, if you're referencing an interest rate, if you're referencing interest-free loans, if you're referencing the speed of approval of loans, those sorts of things. As soon as you have that trigger information in there, you're required to put that additional information in as well.
That's great, James. Thank you so much. There's been an interesting question here about the consequences for not complying, and I think that might be a useful one to ask now. What are the consequences for not complying with the advertising regulations?
Now, of course, remember, Sonia, these can always be avoided, but failing to comply with the advertising standards is a breach of the responsible lending principles. And as a result of that, a judge can award pecuniary penalties. So that's up to $600,000 for a company and $200,000 for you as an individual.
Okay, that's good to know. So we've got a question here in relation to unreasonable fees. So jumping from advertising into fees, what are some of the red flags in terms of potentially unreasonable fees?
Yeah. Look, percentage-based fees are always a red flag for us. We haven't seen too many of those recently, which is good. And also fees charged for activities that aren't carried out. So we had an example where we prosecuted a company for charging an FSPR registration fee when no registration was put of that security on the FSPR. So that again is another big red flag for us. The other thing I would mention is that if you've got unusually high fees compared to other lenders, we usually get notified of those through our online complaints from people as well. So not really a red flag, but just an interesting thing to note there.
Yeah, great. Okay, so there's another question about fees, and this is in relation to charging different rates of interest depending on a customer's risk. So the question says, if I'm charging different rates of interest depending on a customer's risk grade, do I still have to advertise the range of interest rates?
Right, look, yes. If you are, the simple answer is yes. If you're advertising the interest rate, it's and you're choosing to risk grade price, you will need to give that full range of interest rates that you charge. Basically, you don't know which customer is going to be seeing your advertisement, so you don't know necessarily which interest rate's going to be applying in that case. And the regulations are pretty clear that if you're using any wording around the interest rate, so for example, from 10% per annum, then you'll need to state that range of interest rates as well. That's
fantastic. So it looks like there's one final one here, I think, by the looks of things, but let's just see how we go. So this one is around the kind of benchmarking of fees. So it says, other than reviewing a lender's fee calculations, how do you consider if a lender is charging too high fees? Do you benchmark fee amounts across the industry? How does that work?
So generally, no. So when we're looking in terms of investigating a lender's fees and their compliance with the fees provisions, we'll be looking at that individually, because different businesses have different costs associated. So we can't compare that to another, even similar like business that we would think looking from an outside perspective. However, I think it's fair to say we have done proactive work in the past, and that is a good way for us as the Commission to be able to identify those outliers in terms of fees. So we have done that in the past. The motor vehicle sector is an area where we did that. And often that is a good way for us to see if anything's sticking out as being an unusually high fee, which may raise questions.
That's fantastic. Great. Okay. Hey, James, thank you so much. It's been really, really useful to talk with you and to hear your knowledge, your experience and your expertise. I do want to acknowledge that we've got questions that we didn't answer. Some of those are because they are grouped in with stuff that we've already talked about, and it'll be covered off. You know, you'll see it when you either read the guidelines, look at the handout, or watch the recording back. And some of them are ones that we're not able to answer either because the Commission needs to give it more thought, or it crosses into that advice giving space, which is a complex one for the Commission. We're here to give information. If you want advice, that's best obtained from your lawyer. Is that right, James?
Yeah, that's right. Absolutely.
Yeah. So thanks so much, James. I'm really grateful for your time. And is there anything else that you want to add?
Look, one of the things that has struck me about preparing for this is that there's a lot of different places to find this information. We've got the CCCFA itself, a lot of changes with that. We've got regulations in different places that are feeding into the changes here. There's a lot there, but I would encourage people to go to our website. We've got really useful guidance that brings all of that together, either on advertising or on fees as well. So have a look there. And also the Responsible Lending Code is a really useful document to look for, both with advertising and fees too.
That's great. Thanks, James. And I see Penny's putting some links in the chat for people. James, thanks so much for your time.
No problem.
And thanks to you all for watching and engaging with this webinar, and thanks also for your great questions. So as we have with all of the sessions, we're running a survey at the end where you can let us know what we've missed or any areas that you need more details around. If you feel like your question hasn't been answered, pop it in the survey and we'll see what we can do to get the information for you. So when this session closes in a couple of minutes, when you close the window, you'll be redirected to an anonymous survey. You can pop your questions in here, and you can also let us know what you thought of the seminar. It helps us improve. So when the window comes up, click continue to go through to the survey. If you have any questions, or if you'd like to have information about this session or any of the other sessions, you can email us at credit.advocacy@comcom.govt.nz. And the link should be popping up in the chat now. So we've got one more session today when Kylie Higgs discusses certification in about 15 minutes time at 11:30. So kia ora koutou for your great listening skills. Thank you so much. I'll close as we started with karakia. Unuhia, unuhia, unuhia ki te uru tapanui. Kia wātia, kia mama, te nākau. Te tiana te wairoa e te ara tangata. Ko e rā e rongo, whakaere ake ke runga. Kia tēnei, tēnei, huie, tai ki e. Thanks everyone. Haere rā.